Hey everybody, this is Jose Blasco. We are about to get started. I'd just like to confirm that sound is good. Like a quick confirmation on the chat box, a quick hello would do. That way I know that you hear me, and therefore we know technology is on our side to start the session smoothly, which is supposed to be the case. But always good to have a quick confirmation, isn't it? How are you, my friends? Good to see you. Very good. So I'm just gonna wait for that confirmation. Let's see, we just hit the top of the hour. So we are now officially live. Thank you so much, guys. Okay, very good. Let's begin our session, everybody. Welcome. Today is November 12th, 2020. It's crazy how times fly. Next thing you know, it's going to be the end of the year. Amazing 2020. Craziness in the market all over the place, non-stop. And certainly we're going to look at the markets today and expect some craziness because there is craziness out there. My name is Jose Blasco. I will be leading the session today, Options with Options. So, of course, the name says it all. We're going to be talking about options and therefore be ready to approach trading from a diverse point of view, where depending on market conditions, we're going to be looking at directional opportunities, non-directional opportunities, credit, debit strategies, whatever it is that makes the most sense given the changing market conditions. And that's the beauty of options. It really allows you to adapt very well to what's available, apart from betting on a specific either market move or direction or lack of direction, but certainly being very well adapted. Okay, so in case you didn't notice or you didn't feel it, I do love options. Anyway, before we start, I'll just highlight the disclaimer so you can read it by yourself. It's now being highlighted, so please read it carefully. It's important information, and I would like you to be fully aware about the implications of what we do when we trade. There is real money involved, isn't it? And therefore, there are multiple implications. Of course, my assumption, which is a serious way to approach my coaching for you guys, is that, of course, the moment you click the button, you are responsible for it, since it's your money and your decision. While I'm here to help you, clarify, guide you, open your eyes to what can be done, what should not be done, what could be done, etc., etc. But in the end, using real money, paper money, larger size or smaller size, that depends on you. Okay, so let's be serious, everybody. And please, I do welcome your participation. I see a few questions already on the chat box, which I'm going to address in a minute. And I love it. That's how it's supposed to be. So please be engaged. Ask me questions. I'll give you answers. If I ask you questions, you give me answers. So we team up on this beautiful project of learning how to trade. Very good. With all of this said, let's begin. This is the beautiful TradeStation, and we're going to start the session as always with TradeStation. We got 43 minutes in front of us before the session is over. So many things to be discussed and explored, and definitely looking for market opportunities. Okay, before we start, quick look at the chat box. How are you, everyone? Gary from Indonesia. By the way, am I pronouncing your name right if I say Gary, or should I say Jerry? So number one, Gary. Number two, Jerry. I'd like to know how you chanted. Certainly, I'm happy to take a look at Apple. Now, having said that, my boss when I trade is the scanner. So whatever the scanner tells me, it's a potentially tradable opportunities, in order to save time, that's where I go. But certainly towards the end of the session, if there is additional time, I'll be happy to look at Apple for you, no problem. Mark, how are you, my friend? Paul, good to see you. Ahmed, I'm doing very well. Yeah, everything is great. Thanks for asking. I hope all is good on your end as well. It's good to have you with us, Ahmed. Anyway, so let's begin, guys. We have a chart of the S&P in front of us, okay? And I would like to start the session looking at the S&P as well as looking at the VIX. From there, as we always do, we'll move into the opportunities that we have in the markets as we speak. And from there, we will move into looking at other opportunities. So it's kind of like three parts for our session. The market, prior opportunities, and new opportunities, okay? Cool. So when it comes to the market, probably I'm not going to say anything that you guys don't know yet, okay? So since, we've been in the election week and after, the market have been moving up like crazy. Many times people expect the market to crash, and everybody believes that the greatest speed is found to the downside. And that's certainly true many, many times. But there are other times where the markets are so powerful to the upside. It's kind of like, wow, it's not expected at all, isn't it? even though it could be expected out of the an election week for this to happen. What I'm talking about is the speed of movement. Okay, that market went from, let's call it 320 to 360 in no time. That's quite impressive. Okay, so lots of volatility. Now, having said that, since the volatility in the market has been to the upside, so what happens is that everything got calmer. Also, of course, the result of the election is now out, even though it's not official yet, but let's call it official. And therefore, there is so much less panic. We can see that well reflected on the VIX that was trading at 30 something before the election week, and now is trading at 23.24, which is much, much lower. Okay. So definitely less premium available, but also I would still say nice amount of premium, because if I compress that chart, well, you may feel like, oh well, 24, it's kind of like where the lows were. Well, yeah, that was if you were to look at August last year as your reference. But if you were to look at, let's say, a daily time frame or even a monthly time frame, so really the lows are more around 10, 11, as you can see down here. Okay, you can see when we get to this point. So in other words, if 10, 11 is the low, 23, 24, it's double than that, and I will not call it that low. So we will find opportunities for credits. Okay, you can see if I look at non-directional opportunities, for example, we have a few choices. Now, it's not as high as when it was trading at 38, and therefore, if I look at directional opportunities, I also have choices, right? Which, if you recall, a few weeks back, the directional opportunities were very poor, very few opportunities to be directional. Why? Because the market was not clearly showing a direction, number one. And number two, because options were very expensive with a VIX of 38. And therefore, the scanner was picking up on that and saying, hey, take it easy. It's not the best time to be directional. Options are very expensive. And when I say directional, I mean debit strategies. You could actually be directional with credit strategies too, and that would have been fine. Okay. Now, at this moment in time, it's not like it's too expensive. It's not like it's too cheap. So we find a few opportunities on the debit, and we find a few opportunities on the credit as well. So hopefully today we're going to have fun looking for opportunities for credit and looking for opportunities for debit as well. Okay. Since market conditions have been changing and options are a bit cheaper now, even though we still find opportunities to sell options at a pretty good price. Okay. Ahmed, it has been a long time for me since last session I joined. I miss you all, my friends. We missed you, my friend. We missed you. Yeah, that's certainly, I had a little bit of a smile on my face when I saw your name pop there. So it's very nice, very, very nice of you to come and join us. Cool. So now we know a bit better about what's going on in the market, right? So now the next thing I would like to do is to look at two trades that we have running as of now. One is a non-directional trade. It's an iron condor that we have with Merck, which is problematic. Okay, we talked about it last week. Last week. So we were expecting, when we took this trade on October 29, we were expecting this particular stock to stay in the purple area. And guess what? A few days later, we had a little bit of a challenge there. And, next thing you know, it was looking like, it was going to go through again. And, at that time, that was last Thursday when we met, we decided to reconvert our iron condor and make it an iron butterfly, as you can see here on the top. It was a conversion from iron condor to iron butterfly to mitigate the problem that the fact that we were breaking these highs could imply, given the fact that the next UFO was so far away, we could have easily had a continuation to the upside. So because the climate, and by the way, the climate is still blue, okay, and that was my indication, if you recall. Because of that, the idea was to convert this to an iron condor. And when we did an iron butterfly, sorry for that, let me say that again, we took the iron condor and reconverted it into an iron butterfly. And the beauty of doing so is that we basically divided the risk of this trade by kind of like 2.5. We went from $200 of risk to 100, more or less, if I recall correctly. So let me see if I can load it and we can see it. Okay, so that's Merck. Okay, you can see here that, here we go. So we had the iron condor, funnily enough, if I recall well, We had the Iron Condor last week showing us, I think it was $35 of loss, if I'm not mistaken. And what we have done, is to convert it into an Iron Butterfly, and that was done by adding all of these below. I'm not going to repeat because we did that, and if you missed it, you can always go back and watch the recording so we can be more efficient with the time today. But basically, with those 3 boxes ticked, this simulates taking the Iron Condor and making it an Iron Butterfly. Okay, and right now, as you can see, the PNL is negative. Okay, so basically we are in that negative PNL area. But again, the most we can lose in this trade, as you can see, is $102.5, which originally was more than double of that. So we limited the risk when we saw the possibility of having this breakout to the upside and that trade to ever work. And what we did also give ourselves the opportunity is that if that stock goes back up, okay, as long as the stock goes back above somewhere around about 81, so then we're gonna be back in profit. Okay, so we just need the stock to go back $1 or more higher, and this Iron Butterfly will pay a little bit, and probably the wise action would be to get out of the trade. Okay, funnily enough, if I uncheck those two bottom additions, okay, you would see that the Iron Condor, since the stock went back down into the purple area, so the Iron Condor that was a losing trade last week is now back into profit with $17 of profit. Okay, $17 of profit. So could you have stayed in the trade and wait? Well, yeah, we talked about it, and the answer is yes. But again, given the indication and the auto climate and everything else, it was looking like a breakout was going to happen, and it could still happen. And therefore, the safe approach that we considered last week was to convert into an Iron Butterfly. Okay. Expiration date for this trade, it's November 20. Okay, so we still have another week to go. So I will leave it alone here, and we can talk about it next week and play with. Sorry for my voice. Play with the different possibilities of the outcomes, so you guys understand better what are your possibilities for your own trade plans when it comes to trading and managing those trades. Because to be honest, another conversion could be done now and reconvert this Iron Butterfly now into something else to keep managing and mitigating risk and so on. Okay, but again, I don't want to make it too complicated. I think that one evolution of this trade from Iron Condor to Iron Butterfly, I think that's good enough to open your eyes to things that could be done with options. Options give you options, isn't it? So it's beautiful. Anyway, we'll see what happens with this trade. Not looking too good at the moment, but again, good news. We did manage to reduce at least half of the risk. So that was a good outcome, given the fact that we were wrong on this trade. So that's good. The next one, and the last one before we start looking for trades, is Intel. And this was a trade that we put together thinking of election. Okay, thinking of the election, and the bet here, okay, was to get into a trade where if, notice I'm using a weekly time frame here, okay, so that was a long-term thing that we did. So the bet here, that was before election, we put a trade in place where if Intel goes, you profit immediately, and if it goes down, of course you lose, but when it gets to 40, okay, Intel is going to be put to you, and since that was done for a credit of 60, then you would basically become an owner of shares of Intel at 39.4, which is $40 minus 60 cents, which is the credit collected. So what happened to this trade? Okay, so let's take a look at what happened. INTC. So loading it here. Here we go. So you can see that this trade is currently making $49.50 per contract. Okay, $49.50 per contract. This is what this trade is currently making. And why is that? Well, the reason why is because the trade was triggered when the stock was trading at 44.52, and the current value for the stock is 45.28. So in other words, the stock went up by $1 so far, and therefore, this trade would start paying you immediately if the stock was to move to the upside, which is what happened. Okay, so because the stock already started moving up, we are making a little bit of a profit there, 48.5, and more to come, assuming the stock will keep going higher. So the more stock goes higher, sorry for this terrible drawing, the more the stock goes higher, the more the PNL will be. Okay, that's what we're going to experience with this trade. If the stock goes lower, then the P&L could get negative below this price, which is 44 something. But again, it doesn't matter, because the moment it gets to 40, we're going to have shares of that stock put to us. And as a long-term investor, we concluded in this trade that we wanted to own Intel. So everything is working according to plan so far. The one thing I would do is to look at the 40 put, which really the 40 puts that you sold, which we have two of them, right? That 40 put is the put that carries the greatest amount of risk for the trade. Now, the credit collected on the puts is what allowed to buy the puts below and buy the call above, and therefore those puts pay for the trade, and actually the trade was a credit of 60 cents. But at the same time, while these puts are paying for the trade, those puts are also the reason for the greatest amount of risk. Okay, so what would you want to do if possible? Well, we would love to, and let me rephrase, January 21st, January 15, 21. So I want to make sure I use the right expression date. Here we go. So the 40 puts are currently trading at 57 cents. Okay. So what would you want to do with those 40 puts? Well, you would love, anytime it's possible to close those puts, you would love to close them and remove the risk of the trade. Okay. Now, I don't want to close them now because I would be giving up on 57 cents, which again, if I do it, is fine. Okay. Why? Well, because I did this trade for a credit of 60. So if I pay 58 to get out, basically I'm in a free trade where I own a call above and I own a put below. In other words, if the stock drops, I will make money with the put. If the stock rallies, I will make money with a call. Now, while this may seem like a risk-free trade, and well, actually it's risk-free if it's free, but while it may sound like an amazing trade, well, remember both the put and the call are out of the money. So if the move takes a long time to happen, the time decay is going to erode the whatever profit you could have made on this trade. So, if you want to be exposed to the directional movement of Intel without suffering the time decay, then don't close the put, because the put is paying you time decay to offset the premium lost on the call you bought and the put you bought. But if you just want to remove the risk of the trade and just be like risk-free and that's it, whatever happens, so then you could go ahead now, okay, you could go ahead now and buy, okay, you could go ahead now and buy the 40 puts, okay? Now, what I'm saying, it's partially correct, okay? So because the credit that we collected, that was 60, was done by selling two puts. So one of the puts would cost me 59 to close. So if I wanted to close both, I would need to spend double, right? And therefore, I would be left with a tiny risk, which is $50 of risk for this trade. And now I am in a beautiful long strangle that would likely work well. But again, in my mind, given everything I just explained, it's just a bit too soon to close this trade, given what I said. And again, if you think about all the surrounding conditions that we discussed when we put this trade together, which is you want to be an owner of Intel. If Intel was to drop as a long-term investor, this is not active trading, that was long-term investing. So then the best thing to be done so far is to do nothing, okay? Just wait for more time decay to hit those puts, or Intel to keep moving higher, or maybe move lower, and then you get shares of stock put to you, okay? Cool. So anyway, so here's where we are done with all the reviews, and now it's time to look at new market opportunities. Okay, it took me a little longer than what I expected, but it's important because I believe some of you may be in these trades, and I want to make sure all of you are cool. So by the way, a little bit of feedback would be appreciated. How you guys doing? Is everything okay so far? Everybody okay? Everybody following? Was this too fast? Maybe you missed the prior sessions and that was therefore a bit too fast. I could understand that, but anyway, I'd love to see your feedback there while I get ready for more trades. And by the way, talking about good and bad, I am actually pretty terrible when it comes to running these YouTube sessions. I almost never ask you. Recent times, maybe I got a bit better, but I almost never ask you for thumbs ups and things like that. If you guys are appreciating what we do, myself or any of my colleagues, when we do naming effects or solid as a stock or head start, all those other sessions that we do, just give us a thumbs up, guys. That would be appreciated. Anyway, let's begin with non-directional trades. Okay, I'm sorting the price from top to bottom. We're gonna start with CRM. Ahmed, good. Chanted, nice, wonderful. Thank you guys for that feedback. So, looking at CRM, what do we have so far? So with CRM, we can see, okay, number one, we can see earnings are going to happen on December 1st. So if you look at the calendar, December 1st is right here. Okay, so we could use expiration dates before that, which is either November 20 or November 27. Okay, so we have 2 weeks to choose from to do an iron condor on CRM. For us to be able to do that, we need to pick at least 2 UFOs above and below, and we need the UFOs to have at least 48% probability, which in this case, we are above 48%. I'm curious to check pre and post market. And pre and post market is showing only 41%. So this is information to be ignored. Okay, so we're going to focus on regular session only, since that's the market data giving us the probabilities we want. Okay, Paul, I'm still learning, Jose. Not trading options yet, but something for the future. Way to go, way to go. There is a famous quote from one of the presidents of the US, which I forgot exactly how the quote is, but it's something like, if you have to cut down a tree, and let's say you are given like 7 hours to do so, so I would spend 6 hours sharpening the axe. Okay, so that's what you do, my friend. That's what you're doing. Okay, that's why some of the sessions we do, we call them sharpening, right? Because it's all about picking up that skill. So when you apply it, you know what you're doing. Okay, it's very wise. So way to do it. Mark, what would be the current situation if you just had sold one INTC put? If you just sold it, well, my assumption, Mark, is that if you sold an Intel put right now, and that's the only thing you sold, okay, you sold one put, is because you want the stock put to you. So then the right action would be just to wait for the stock to be put to you, or the option to become, depending on your trading plan, 5 cents, 10 cents, whatever it is, and you close it. Selling a put, either selling a naked put or selling a cash secure put, any of both actions implies that you are happy with delivery. If you are not happy with delivery or assignment, and you did it, then there is a problem, okay? Because you should not do that if you are not looking for assignment. If you are not looking for assignment, you can use spreads or other type of techniques, but certainly not a naked option or cash secure, okay? Cool. Okay. Very nice. Perfect. Okay. So let's begin our planning of a potential iron condor on CRM. Okay. And Mark, hopefully I got your question right. If I didn't get your question right and you want to elaborate a bit more, so I get you, you let me know. Where this trade be now if you sold the put last week? Oh, okay, I got you. Yeah, so if I go back to Merck, okay, you will be in a profit for sure. Let me see. Let me show you a better way to see that. So if you look at Merck, okay, and you look at January 15, and we are looking at the 40 put, right? Sorry, not Merck, Intel. I'm like, made a mistake there. Intel. Here we go. So what I will do first is go to the 40 put and right click and copy the symbol. Okay, that's what I will do. Copy the symbol. And then when we look at Intel, so I'm diverting from CRM, but I'm coming back CRM, just 1 second. So we did this trade, when was it? The election was on the 3, so that was the week before. So that was on the 29th or the 30th of October. Okay, I think it was on the 30th of October, if I'm not mistaken. Okay, 30th of October. Okay, so what would I do? Well, I would just go ahead and paste the symbol of the put on my chart. Okay, and go find October, oh, just moved. Okay, let me do it again. So October 30 was somewhere there. Okay, so let me zoom in. Here we go. So what would you have? Okay, well, that day you would have sold the puts for around $1.4, and today the puts are trading at 0.59. So the difference would have been your profit. Okay, this would have been the case, Mark, if you had done this trade. Make sense? Okay, so going back to CRM, we got 20 minutes, so let's see. I think we should be okay to plan an iron condor. Of course, we need CRM to be collaborative, okay, and meet our rules. Let's see. So we have CRM. Wonderful, Mark. Wonderful. So we got CRM. So again, we said we can use November 20 or November 27. November 20, it's shorter expression. Also, November 20 is a monthly expression day, which is more liquid. So I'm going to start with that one. And if it doesn't work, I'll take a look at the next one. Okay, so notice I am analyzing to sell an iron condor. I clicked anywhere randomly. It doesn't matter which strikes I selected so far. And with those random strikes so far, okay, I need to adjust that. I need to make sure my expression date is the right one, and this in that first step allow me to see what is my one standard deviation above and below, which is 236 and 267. Okay, so 236 and 267 is where? So 236 is more or less here, and 267 is more or less there. Okay, so the statistical range that we are suggested that stock is going to stay within is from the current price, which is 251, is going to be between 267 to 236. What are our rules? Well, our rules is to use at least 2 UFOs above, 2 UFOs below. So obviously above I got 3, below I got plenty, but they seem to be further away. So this is UFO number 1, okay, and UFO number 2 is there. So if I use that one as a reference and I measure the vertical distance from the current price to that UFO, okay, that's the vertical distance which I'm measuring right now, and I take this vertical line, which is thin, and I make it thick, and now I just move it and project it to the upside. So I do have a problem, and the problem is that, for me to do an iron condor and that iron condor to be very nicely executed, very well equidistant with the current price, I would need another UFO up here, which I don't think we have, because if I look at the monthly time frame of that stock, notice how that stock is basically making all-time high, and therefore that price is the highest it's ever been, and therefore there is no UFOs above because there is no market data. Therefore, unfortunately, I cannot plan on an iron condor. Maybe I have that stock on the neutral list. No, it's not. Well, and you can see why not. The climate is not confirmed for CRM, and that's why it's not there. Okay, so we're gonna move to the next one, which is Workday. Let's see if that one does provide us with an opportunity. So we got 46%. That's a no. Also, another no, I'm not going to stop there, is earnings around the 19. Okay, so I'm going to pass. What about Target? So with Target, okay, we got earnings on the 18, so that means that we're going to pass. We got VMware. So, one second, guys. I am sorry for that. I just had to sneeze. So VMware has earnings on the 24. You can see that here. Okay, so being the 24, we can go ahead and consider doing a trade utilizing November 20. Okay, now for that, I need at least 48%. For now, I got 47% if I look at regular session. What if I look at pre and post market data? I got 34%. Guess what? It's a no in both cases. What about NetEase? So net is have earnings on the 19th, so that's going to be a no. And therefore, we have one left, which is run. And with run, there is no data available for earnings, which is always something that makes me quite uncomfortable. So let me go ahead and take a look at a study, which is EPS postings, to see when the last earnings took place. And guess what? The earnings just took place a few days ago. You can see here that earnings per share 0.30 were reported like just a few candles ago, isn't it? So because earnings happen every 3 months and earnings have just been reported, so it happens that they have not notified the next date as of yet. That's why it shows us no data available. But I am indeed okay with planning a trade, assuming everything is going to be good for that stock, given the fact that we do have that information about earnings under control. Okay, a different story would be that I have no idea when the earnings took place. Then I would be very uncomfortable. Okay, now 40%, that's not good enough, and that's pre and post market data. What about regular session? Regular session is 47%, and guess what? It is not good enough either. So today, which is not that expected, to be honest, with a VIX of 24, I would have expected that some of those stocks could have provided an opportunity for us. We were close with CRM, but it didn't work. And the other ones happened to be, many of them were stocks too close to the too close to the earnings date, and therefore we didn't have time enough to the next expiration date to put a trade in place. Okay, so no iron condors today. Okay, you guys may be disappointed because in recent times we've done a lot of iron condors, and I think that I don't know. To be honest, I don't remember exactly, but I would say that maybe one or two failed since months ago. All the other trades have been profitable, which is the consequence of a very high implied volatility and great premium in the options. It's not like we did something magic. It's not like that we were lucky either. It's just that the more expensive the options are, the more people expect the world to end, and options are trading at prices which are unreasonable, the better the edge we get as a trader, because now our ranges become very, very wide. Thanks to the implied volatility built in our calculations, as well as the values, the extrinsic value built in those options. And we've had a great collection of trades that were all profitable, and just very, very few, I would say one or two, I believe, that didn't work well, but all the other ones did work very nice. So that's nice. But today, no iron condors, okay? And we're not gonna force it. You could certainly go ahead and rerun the scan, and if you have one, go for it. But we are not gonna force it and be like, okay, but you know what? I'm gonna do one with Facebook just because. No, follow the rules. Okay. If the scanner in this case, which is adapted to the market, it's telling you those are your symbols. And today we got 6 ticker symbols, which is very, very poor compared to what we were used to, but that's what it is. Well, there is a reason for it, right? Or there are 2 reasons for it. Number 1, options are less expensive today. Number 2, because the market has been moving so far, so strong in a specific direction, which in this case has been up. So what happens to most of the stocks in the market? Well, most of the stocks, including the ones that were quiet, started picking up speed, and therefore they are not valid candidates for non-directional trades any longer. And that's why the scanner is giving us very few opportunities today compared to what we have seen in prior weeks. This, my friends, is called adapting to market conditions. So what do? Well, you can go ahead and look at credit opportunities, which again you have, like in this case is 8 for bull puts. For bear calls you have 8 as well. So you can certainly go ahead and take a look, and I would say that you should find maybe 1, maybe 2, whatever. You could do that. But another way to approach your adaptation to the market is also look at directional opportunities, which today we have more than in prior cases. Since most of the trades I have been executing for a long time have been trades that were non-directional. So if that's okay with you, we got 10 minutes left. We're gonna go ahead and look at directional opportunities today, just to give you a little bit of different flavors and possibilities. So for the ones of you watching the sessions in a regular basis, you get more material to learn from, and also to use and apply and practice with to develop your skill. Okay. So same story. I just sorted all those directional long opportunities by their price. On the top, I got Roku. So let's click on Roku and let's see what's going to happen. Okay, and now, of course, I'm going to apply a different approach, a different methodology, which has me first thing I'm going to be doing is I'm going to be looking at the climate. Okay, this is the first thing I'm going to do. I'm going to be looking at the climate. Okay, so what's the climate telling me about Roku? Well, it's telling me thick and blue. So it's an up climate, time to be a buyer. That's why we got Roku on the scanner. This is candle number one, which is probably the best time when to enter a trade, because if you're right, you catch the whole climate propagation. And that climate, when propagating, will propagate for 10 candles. So certainly looking good for a trade from that point of view. Now we have more requirements, okay? And by the way, those requirements are quite demanding at times. Because when you are directional, guys, you better be right. You know, when you do non-directional trades, you got a huge amount of room to absorb price movement, and it's okay. But when you are directional, you better be right and be right soon. If not, the trade is now hurting very badly from the beginning. So what's happening with this is that we have a requirement for probabilities which is higher. Instead of shooting for 48%, our minimum is 50. So what happened with Roku? Well, we cannot do a directional trade because right now we have 49%. So let's take a look at pre and post market to see if that's good, and that is good. Okay, and that is good. Now we have 51%, and then now the door opens for us to do a trade using Roku, using options. Okay, now what else do we have? Okay, so we have the climate, beginning of the climate. The climate is going to propagate, or is likely, based on probabilities, going to propagate for 10 candles. So what do we want to do? Well, we want to plan a trade, but we need to make sure that we are respecting our reference value, which is 224.91. And we need to make sure that that value, which is a reference price for the trade, we need to make sure that value is lining up, or more precisely, I would say that value is being enveloped by a UFO. And in this case, we have it right here. Okay, and the probability, as we said before, is more than 50%. And 225 to 228 definitely envelopes to 24.91. So in other words, we do have a green light to put a trade on Roku. I just need to find out where my target is and then pick the right options, and we have a trade to be placed. Okay, Mark, my tradestation says 50% regular session. That mark, it's either because you have more or less candles than me on your chart. Okay, in my case, I use 1,587 candles on my charts. Or because you use a different calibration metric on AutoUFOs. In my case, my calibration settings are 0.618. You may be using 0.50, 0.55, or any other calculation. Okay. So of course, if you have different calibration or different amount of data on the chart, the values will vary. It doesn't matter if it's different and your plan is different and you have a reason for it. What matters is that you always use it the same way. So you are mechanical on your approach to trading. And that may mean sometimes you agree with a trade I take, and that may mean that sometimes you don't. And it's fine. As long as you act mechanically, you have consistent action, that will lead to consistent results. If you have random actions, that will lead to random results, unless you're lucky. If you add luck into the mix, of course, anything could happen anytime. But through time, probabilities should be more powerful than luck, right? Or another way to say that is luck is dictated by probabilities, But anyway, your setup is the same, so that is really, really running the scanner has nothing to do with this probability value, Mark. This probability value has to do with AutoUFOs, and that is totally independent of the scanner. Okay. Cool. Anyway, so let's continue. So Roku. So we said we have a valid entry point. I want to document this on the screen properly. But first, let's find a target. So if I turn on AutoUFOs for that stock and I scroll down, down, well, what do we notice? Okay, well, we don't see any red UFO. which would be the UFO I would like to use for my target. So why is that? Well, if I look at Roku and I look at a monthly time frame, notice that that particular stock, it's basically making or about to make all-time high if things go according to plan. So because that stock is making all-time high, there is no way to set a target because there is no market data above price, so we have no idea. It would be a guess. So my proposal to you will be to trail stop, and once you get into this trade, just trail stop, trail stop, trail stop, and let's see how far it goes. Okay, and if it was to violate your stop or your alert condition, then close the trade and get out. Okay, so we are looking to get into this trade. We are planning the trade today, which is 11/12. We are looking at entering at this price point, which is 227. Okay, that's the top of the UFO, from 227 all the way to 221. So that envelopes our reference value in the context of an up climate, but we're going to use 227. Okay, and because that market is making all times high, this is going to make our trade very, very, very simple, very, very, very simple, which is we're just going to buy a call. That's it. We are not going to do a spread. We're not going to do any fancy combination, because if we were to do that, we're going to be entering the territory of capping the profit of the trade. If you do a spread, the most you can make is limited, right? And because we have an opportunity where we may have a major breakout when markets normally starts making all-time high, we often have these very powerful breakouts. So we would be capping that profit if we do a spread. So we're going to make the trade a bit more expensive, but we will expose ourselves to that potential breakout with unlimited potential for profit, which of course we will take profit at some point. So we will make a limited amount of money, that's for sure, if right. And it's okay to make the trade a bit more expensive, buying the call instead of doing a spread, given the fact that this is in exchange for a potentially larger profit as well. Okay, so we're just going to go ahead and plan on buying a call. Now the question is, which call are we going to buy? Well, notice that we have no data related to earnings. Okay, we have no data related to earnings. Again, if I look at my EPS postings, probably it means that earnings were reported not too long ago. And here we go. They were reported on that date, which is on the 5th of November. So that was 1 week ago. Okay, 1 week ago, earnings were reported, right? So in other words, it's going to take another 3 months for the earnings to be reported. I don't know when it's going to happen, but at least 3 months later. So if I look at Roku and I look at the options chain, and I look at something that is more or less 90 days out, well, I got 640155. Okay, 640155. Well, it seems that it would make sense to go for the 155. It's unfortunate that we don't have a 90, right? It would make sense to go for the 155, but to be honest, 155 is even more than double than 64. So we're going to make this trade so expensive if we buy an option. So notice how the at the money, okay, if I look at the at the money here, like it's going to cost you like $3,500, where if you do the January 15, it's going to be like $2,000. So it's like 50% cheaper. Okay, still it's an expensive trade, given the fact that we got like 55% implied volatility built in here, and the price of that stock is $229. Okay, so definitely this is not an ideal trade. It's quite pricey to buy a call, to be honest, and we never discussed that in the channel, so I will not do it today. But just for the ones of you very advanced with options already, so a much better way to do this trade to mitigate the risk would be to do a butterfly, not an iron butterfly, just like a directional butterfly, a long butterfly, or what is called as well as a call butterfly. That would be a much better way to take care of dropping the cost while we manage, a lot of the risk when it comes to volatility, as well as we allow ourselves for a profit which is probably greater than what you could achieve with a spread. Okay, but anyway, that exceeds what we're doing in the channel so far. So I'm just gonna go ahead with buying a single call, as I said before, and I'm just gonna be planning my entry to be 227, right? and therefore, while I do have plus and minus 1 standard deviation above and below, I need you to ignore that, and I need you to focus exclusively on the column in the middle, and more specifically on the delta. So the rule we have is we want delta to be around 30. Okay? Yes, Maca, for sure. We'll get very advanced with options at some point. Yes, definitely. But we do need to add material before we can do that properly, because that would be very, very confusing. And I'm all about sharing with you guys, but at the same time, um, how do I put it? It's like too much power without proper control. It's actually dangerous. So I may hurt you by sharing too much information in 45 minutes without the proper preparation. So I have to plan for this and do certain preparation sessions. Maybe we do some sharpening, we do some, let's call it theory days, okay, and then we can implement it in the market instead of throwing it out there, speed of the light, and maybe, okay, maybe I'm wrong, okay, but maybe some of you get it like, oh, I got it, and maybe you didn't fully understand because I went too fast, and next thing you know, you put real money in the trade and then you get hurt. And I just don't want this to happen. Okay, I prefer to give you something a bit simpler that may have a bit of room for improvement, but that I'm more positive that you won't make mistakes with it, because I don't know how much training and options you guys have received. Everybody in this group is different, so that's my challenge, if you wish. Okay, but anyway, so we are looking for a delta around 30. This is delta 49. So what I would do is take that 235 and move to the next strike, which is 240, and that it's making it 45. What if I make it 245? That's going to make it 42. What if I keep going higher and higher and make it 255? So now my delta is 35. What if I make it 260? Now my delta is around 32. Okay, so now this is good in the sense that now the cost of the trade is going to be 986. So we're talking about a $1,000 risk trade. Okay, so again, this is not a super cheap trade at all. Okay, that's why I was mentioning earlier that with a butterfly approach, it would be much better. But again, good enough. And if that's too pricey, maybe what you want to do is you want to go ahead and execute this trade in a paper money account. At least you learn from the experience. But keep in mind that if you pay 1,000, the most you can lose is 1,000, and that's your risk. Okay, so that's the trade that we're gonna do, guys. Okay, so we will be planning on buying the 260 call. Let me document it. Okay, so we are buying the 260 call, which is Jan 15, 2021 expiration, and we need to watch the earnings date in case they change it and it's happening before, so we get out, and then we're going to be trailing stop, okay, to maximize the profits in a perfect world if that stock ends up making all-time high, which is certainly a possibility. Okay, now if the stock goes against us, okay, what do we do? Well, many things could be done. My approach is going to be we do nothing, because I am assuming that you're going to be running this trade in parallel with other trades, where some trades are going to be pointing to the upside, some trades are going to be pointing to the downside. All of those trades are going to be debit strategies, and therefore all of those trades will be positive gamma, and therefore they will kind of offset each other. It's kind of having a hedge, isn't it? So I will allow for that stock to go against me, knowing that in my portfolio I got other trades with puts that profit to the downside, and then collect profits with the other trade with the puts, and hopefully those UFOs will bring this thing back up sometime in the future, and at least I make some profit with it. And if it doesn't, well, the most I will lose is 1,000 while other trades paid me. Okay, and the idea is to run a diversified portfolio, and there are some recordings on the sharpening playlist that talk about portfolio management and stuff like that, so you may want to watch that. With all of this said, I have exceeded the ending time of the session, as almost always. I love spending time with you guys, but also let's be serious with our time usage for all of us. Time is money, and the market is open, so let's go trade. You guys take care, keep up the good work. Any questions, support at tradictiv.com. It's always a pleasure to receive your questions, and we normally give you answers pretty quickly, isn't it? So send your emails, and certainly if you prefer to discuss your questions here in the YouTube channel, bring them in. Don't be shy to type on the chat box. It is indeed a public forum, so some of you may be like, oh, I don't want to type stuff. So hey, send an email with your questions, okay, and say, hey, would you mind to address that in your next YouTube session? Please don't use my name. I want to keep it anonymous, but please give me an answer. Okay, so yeah, guys, you just need to ask for it. Okay, no worries. We're here to help. You guys take care. See you soon. Bye bye, my friends. Take care.